Good afternoon and welcome to IG's latest webinar that follows on from our exclusive PF2 Roundtable held on 14th Feb at the IGA premises, featuring Infrastructure UK head Geoffrey Spence and 12 eminent UK infrastructure stakeholders. This webinar aims to highlight and discuss the most important themes that came out of the Roundtable, which was held under Chatham House rules. In addition, this webinar will also explore the various facets of the UK's PF2 procurement model, while providing some foresight for infrastructure procurement in the year ahead. I'm Sakshi Sharma, senior reporter at Infrastructure Journal, and will help facilitate this session. Before I introduce you to the other members of our panel, a few housekeeping rules. If you are having trouble hearing in, please notify us by using the chat box in the GoToMeeting panel. We like these sessions to be as interactive as possible, but please feel free to ask questions using the questions function on the GoToMeeting panel throughout the session. So today we have with us IG editor John Kjorstad, who will chair the session and help steer the debate. Joining him on the panel are two of IG's webinar favorites, Mark Richards, partner, project and infrastructure finance at law firm Berwin Leighton Paisner. Mark has extensive experience in the PPP sector and has been involved in some of the high-profile PPP and infrastructure deals, both at the depth and equity side. Along with him is infrastructure veteran, not by age, by experience, Nick Pryor, head of infrastructure and capital projects at Deloitte. Nick has held various prominent positions in the public sector, such as leading the private finance unit at the Ministry of Defence, being a member of Eton Treasury's Projects Review Group. Previously, Nick was also Projects Director at Partnerships UK, with responsibility for working with Eton Treasury on the development of financing structures on the delivery of UK infrastructure across various sectors. So we're going to kick off this webinar by presenting a research report provided to us by our sister publication, Glendon. Glendon provides a comprehensive database of UK construction activity. What we can do is the first slide, which basically tells us, draws parallels between the UK economy and sort of falling in construction activity. Construction has been on a break on UK economy, falling output in 3 of the last 5 years. So if you see, there's a bit of an uptake in 2010 and 11, but then there's a downward trend since 2012. In fact, the governor of Bank of England noted that it was declines in construction output that have held back the UK economic recovery. Then on our second slide, you can see there's been some signs of recovery in private sector, but confidence is still fragile, and access to project finance has hampered recovery. There's been deep cuts in public sector investment, overshadowing private sector recovery. This is especially evident in the funding and delivery of major capital projects, the sort of investment that the government has identified as important to securing long-term growth for the economy. On the next slide, we can see that there's been quite a slump in PFI activity specifically. There's been a reversal of trend in major projects since 2009. Even if we take M25 in consideration. There's been a downward trend which has continued into 2012. Lack of project starts over the last 3 years, now acting as a drag on construction and UK growth as earlier schemes completed. So overall slump in PFI activity. And then on the next slide, we can see that almost half of the major PFIs, even though they started over the last 3 years, they've made a substantially reduced contribution to project starts over that time. So there's a bit of a comparison there between PFI, public sector only construction, PPP activity, and private activity. So I think that sort of gives us a good segue into PF2, which is one of the ways through which the government hopes to procure new infrastructure and kickstart reconstruction activity. I'll just quickly say that PF2 was launched by the government formally in December 2012 alongside the autumn statement, and it promises to reduce procurement timelines in UK infrastructure. There is going to be an increase in public equity stake. There will be removal of soft facilities management, and hopefully PF2 will be tested by the schools program. I now hand it over to John to take the discussion ahead. John.
Okay, thanks, Sakshi, and I didn't quite get the glowing reception that Mark and Nick got here, but a couple of things to note. First, overall slump in PFI activity. That's a bit of an understatement, I think. And then the uptick in 2010, I was wondering, maybe my colleagues here could comment on that in a minute about if they remember those heady days in 2010 when they thought we were all maybe coming out of this and moving in a different direction. Not that long ago. But before we do that, I just want to underline an important point that the opinions expressed today are those, obviously, of the individual panelists, and we wouldn't dream of putting words in the mouth of government based on our breakfast briefing, which was held under Chatham House rules. And as Sakshi said, today we're going to cover the overarching themes of that conversation and try to answer the audience's questions on the topic. So this first slide and the first point of debate is the role of public equity. We were talking just briefly before going live about this, so maybe Mark, if I could turn this over to you. This has been something that has been quite a testy point of the new PF2.
Yes, John, and frankly, the first thing to start with it isn't BSF. This is a new form of public equity, and I think actually it's really, really important. I think that having been to a number of our UK presentations in the public and also been at a few seminars, a big theme coming out of this public sector equity is effectively that the market wanted it. The market wanted the public sector at the board table. They wanted to have an alignment of interest. They wanted to have this partnership ethos. I'm afraid I'm going to use this expression a couple of times. I think the devil's in the detail. We're still waiting for the shareholders' agreement to come out. I think it's in very, very limited consultation. I haven't seen the copy yet to understand what this co-investment stake is going to look like and how it's going to operate. But there are other issues which I'm sure we can talk about around funding competitions around private sector equity. But generally speaking, I think, unless from people I've talked to, the market itself wanted this.
That's interesting because we had the World Infrastructure Summit in November last year, and public equity was discussed there. And this was prior to the announcement of in the autumn statement of public equity, and there was quite a few sponsors, traditional kind of sponsors, the industrial sponsors, who were a little bit skeptical about it. The people who were kind of in favor of it or arguing it were more the fund and the specialist infrastructure fund folks. So I mean, and they see it as, look, this is government wanting to get a bit of transparency in the process. We can live with that. Nick, what are your thoughts?
Yeah, I mean, I was surprised at this. That I always feel that the public sector should do what it does and private sector should do what it does, and we should keep it fairly straightforward. So I was surprised, but there's no doubt the feedback of the Treasury-run consulting process, whereby they sort of took the views of the market, was that the market substantially wanted it, I think, and Treasury officials, I think, were quite surprised too that was the view. And it wasn't just the funds as well. It was actually the developers who were pushing quite hard for it. And actually, I think the stars kind of aligned at that point in time, because I think at a political level, with Treasury seeking to bring together, and let's not forget we're in a coalition here, two parties who both had serious concerns about PFI. I think the introduction of public sector equity, as Mark said, for transparency reasons, to help share upside where it occurred that couldn't be necessarily controlled as much as they would like, particularly some of the disposal proceeds, the refinancing proceeds. It all came together. So politically it worked. The developer, the fund, the industry wanted it to work, and that's why we have it. And if it allowed it to happen, which I think it played a really quite significant role, certainly at a political level, then that's got to be good. The workability of it, I think, as Mark absolutely points out, is in the detail, and we'll see how that flows through. And the other thing that came through from the process of consulting with industry was that it worked really well in some places and not well in others. And actually, I suspect, well, I'm almost certain that will be an ongoing situation. And whilst the contract will say, the shareholders agreement will say one thing, a lot of it depends on the developers and the representatives of the public sector at an individual level working together, and it'll be as much about personality as it will about contractual detail. But you know, if it allowed PF2 to happen, then it's got to, you know, we have to say that's good, and let's work with it.
And it's not entirely new. There are some precedents even here in the UK where public equity has worked. Was it Lyft?
Yeah, Lyft and BSF, and they've Lyft has had marginally more success than BSF, but BSF is effectively that equity stake has now disappeared into a private sector fund. I think just picking up on Nick's points, I think it's really important we do take a step back and just remember just how toxic PFI was. And nothing happened for a year or two because of that toxicity, or at least that's a word. You know, and we needed to cleanse, we needed that detox, and this has kind of done that. And you know, if you want to play with government and you want to do these deals, these are the rules now. So I think we have to work around this and how this operates. I think a lot of clients and contacts have been talking about, it's a really unusual expression for UK, talking about political risk. And in a sense, you almost see that the public sector getting involved in equity stakes, in a sense, almost reduces that political risk. You know, you almost have a, you know, you always have a beta, you know, you always have a beta G transaction anyway. But to have governments in business as well, having them aligned, having those stakes aligned with industry, could be no bad thing. If we have another repeat of operational efficiency reviews that we had a year or two ago. So I think it's almost, you can almost see the public sector equity almost as a sort of a chip on the table, a kind of a political insurance bet, saying, look, you know, these are the rules. Here's you can have a stake in the game, and actually, you can protect ourselves by aligning our interests together.
Can I play devil's advocate just 1 second and suggest that others out there might actually see this as increasing political risk, because in a way it gives the political sector a chance to interfere with the management of the assets. And I think that's potentially something that, you know, you were talking about keeping the public and the private, and keeping them separate. I mean, one of the reasons that we think public-private partnerships tend to work is because it brings certain efficiencies in that the private sector is good at, and allows the private sector to make difficult political decisions around an asset in terms of how it's run and operated and everything. Whereas, obviously, if there's more political sort of significance in there, i.e. job losses or something like that, that might cause a bit of conflict. Do you guys see that as potentially happening?
I don't think it, I have to say, I don't think it's going to make a huge impact on that front, because I think at the end of the day, the public sector was very much involved whether they had equity or not. So a number of these more challenging decisions or controversial decisions, I suspect the SPAT would have been there in any event. So I don't think it's huge. From a debt side, I can see from my own previous experience working on the credit side, I can imagine this would be attractive to credit committees, because I think they like the idea that they are backing a project that the public sector has got there, I think, has not put a chip on the table. And I think one issue that I do think is important is that if the public sector starts taking, and this, again, it's not clear at the moment as to the level of the stake the public sector would take, but if it comes at a level whereby it obviously significantly reduces the private sector opportunity, you're going to start reducing significantly, quite potentially, the number of players that will be interested in projects as the private sector stake gets smaller, because the investors, be it funds or even developers, but particularly the funds, if the stake gets too small, then they'll say this isn't for us, it's not worth it. So I think government needs to make sure that it doesn't start to increase its own stake at a level where it impacts the size of the market for the private sector stake.
I totally agree with you, and some of our clients and contacts on the developer side take a very holistic view, John, on their return. They say, well, actually, we're only going to win 1 in 3 of these things, so actually I'm going to max up as much of the equity as I can in bidding, and on top of that as well, take some kind of return from my O&M or EPC D&B contract, and then look at that in the round and see what I made on that project as 1 of 3 projects that I might win or might not win. Reducing the equity, reduces that overall holistic return to those developers. And we are in a competitive world, and some of these developers are multi-jurisdictional developers, global players. If there's opportunities and those returns aren't right for them, they'll take their capital and play elsewhere.
I think this is a good segue into one of the other kind of related points around PF2, which is getting competition for the equity stakes. I have to admit, I'm not as sharp on this as Sakshi here, but maybe one of you guys can enlighten us on how this is going to work.
Nick, go ahead on.
Maybe nobody does.
No, I'll give it a go at a very high level. I mean, the detail is not out yet, so it's yet to be determined. But the theory goes that there will be a equity competition for a portion of the equity yet to be determined at the third stage, and that's pretty much as we know, I think.
Why is that? Why would they do that?
Well, it ensures that the pricing of the equity is as competitive overall as it can be. I presume it creates greater access to the market for new players coming into the market. It gives better demonstration of value for money.
Can I point out what the PF2 document says? And that's not hiding behind it. It's curbing returns on secondary market investors' ability to churn that equity going forward. If they can get long-term players in day one who aren't going to churn that equity, they don't want massive windfall, for a better expression, secondary equity trades. They don't like that. Politically, it's not seen as being acceptable anymore. I think it's one of the themes coming throughout PF2. So this is one way, and there's a number of others to curb that.
I think that's an interesting point you make. In terms of a lot of things to do with government these days, it's almost like it might not be illegal, but it's not moral kind of message keeps coming out.
Yeah, I mean, I remember when I was working back with the Treasury a number of years ago, we looked at exactly this same point and thought about whether it would drive these sort of behaviours, and shied away from it at the time because of, I think, just nervousness about interfering with the market. And I think what this shows, as PF2 probably more broadly shows, is that times have changed. Different place now. The concept of value for money has to be demonstrated, and has to be demonstrated in a very transparent way. And I think this is another one of those mechanisms that have come in there that, 6 or 7 years ago just wasn't right for the time then. But in the current climate, it's absolutely right. And not only do we have to do things right, we have to be seen to be doing things right. And this is all part of that. And I think I can't remember who said it, but that's about the way you have to work with government nowadays. You either do it or you don't. And I think that's we have to learn to live with it.
And I think looking at this public sector equity, I think that we're still waiting to see the detail. And I think some of the detail was in the documents around there being some kind of centrally managed entity or part of Treasury looking after this equity stake in a non-conflict way, making sure that the equity that's invested is on the same basis as the other investors, the other private sector or institutional investors. The public sector co-investing, shoulder to shoulder, and the proportion of equity that's going to be put out to secondary markets and the portion of equity going out to the public sector is going to be turned on almost on a case-by-case basis in the tender documents. But all of these aspects are all safety valves around, in my view, around making sure one of the themes coming through PF2, curbing this kind of political toxicity around windfalls.
Right. We've got a question here. Look at some faces just to judge whether or not anybody wants to answer. Are the panel concerned about the fragmentation of public sector on the strength of covenant offered, for example, CCGs, academy schools, NHS, etc.? And then after that, we'll move on because I think this segues nicely then into managing project costs. So,
look from a funding perspective, when I talk to funders and talk to institutional investors, the AAA rated or near as down at AAA rated of UK governments is very important for them. So finding that they have, those government entities have varies. You look to the indivisibility of the crown. You look to that covenant strength is really important to them. It kind of writes itself in the bond documentation. When you look at the NHS, getting that deed of safeguard and Residual Liabilities Act protections are really important. It's almost the first thing they say. So, joking aside, discussions when we talk about bond financing Scottish projects from other institutional investors who will be worried about independence is going to be quite an interesting discussion. So, as you say, when you're talking about LIFCOs, these community foundation trust entities, that all these entities which may not have the same governance strength as government is going to be quite concerning to funders. I think it's going to be more concerning to funders who have credit positions in those projects already. And I know that a number of my clients and contacts have been having a few sleepless nights around their existing projects that they have out there at the moment, and whether they continue to have the protections that they thought they had when they entered into them. And there's a lot of discussions going on at that now. It's actually a bit too premature to actually just determine how that outcome's going to go, because I think there's a lot of discussion going on behind the scenes between Department of Health and the Treasury and a number of other people around those regimes.
I'm sure you put protections in your legal agreements to ensure that the covenant couldn't be withered away.
Yeah.
Yeah. What are your clients worrying about then?
Yeah. Another question, follow-up question, and again related to, I think, the discussion around managing project costs. Do we have a true market of infrastructure operators in the UK, or just short-term interest from building contractors using highly leveraged SPVs? Now, highly leveraged SPVs, that's obviously something we're kind of getting away from in the sense of PF2, because of one of the things government seems to be, very discouraging of is leverage at the the degree we saw in, say, 2006, 2007, when you had 95 debt or 5 equity or something along those lines.
Well, so do we have a true market of infrastructure operators? We do. There's plenty of players out there that in the UK market. All of them, well, not all of them necessarily, but many of them undergoing significant stress in this process. You only have to look at the construction statistics that we were highlighting at the top end of this to see that the level of pipeline there is significantly reduced. The opportunity is significantly reduced. The major players are still there, but they're looking to other markets. They're looking for where they can get better returns. They're looking for where they can get activity. But it is there, and what will it look like in 2-3 years' time? Well, I have to say I don't see any significant increase in terms of the opportunity for the infrastructure players over the next 24 months, certainly not before the next general election. I won't take the conversation straight off into pipeline, but I think for the opportunity that is out there, there is certainly enough supply on the market player side, but the pipeline is not helping.
I think one of the interesting, maybe hidden nuggets of that question is actually the short-term interest, because I think we always used to like to say in infrastructure that it was a long-term game, but in reality, there's lots of businesses within the infrastructure space that all had short-term exit strategies, and that was part of what created the secondary market. Is that going to change as a result of kind of the seismic shifts that are happening?
I think the returns are going to change. I think the returns might be slightly depressed.
Because people have longer-term strategies.
I think the institutional investors, if they're attracted by PF2 to invest in equity, will. I think the public sector will remain now, though it's quite interesting to see they have tag-along rights with the, as I understand it, in the shareholders' agreement, as mentioned in the PF2 documents I've seen, so that if there is some kind of secondary deal, they can tag on their equity at the same time and disappear as well and recycle their equity. So I think that you can look at it as short-termism, but I just see it as being different people with different roles at different times of the project, and capital will deploy itself in different ways. I mean, the construction contractor, it just seems ludicrous to me, just as it's a mere scribe than a financial engineer, but to think about a building contractor keeping a large slug of its balance sheet in an operational contract. Why wouldn't it want to recycle its capital in the usual way? I think Nick highlighted a point which was I didn't really consider is people's roles. Should the public sector be doing that? Well, they are. These are the rules of the game. But for building contractors decide to recycle their equity, considered to be short-termism, I just think it's the nature of what they do. So I think there is a long-term market for infrastructure.
Then you could also argue that for the particular developers you're talking about, that actually, once they've been through that part of the project, it's quite right, they do recycle their investment, because actually they're not best placed to manage it thereafter, because that's not what their business is. And, the more liquidity in the market, the better it is. So I don't think it's an issue.
Do you think it'll threaten liquidity, though? I mean, the sort of infrastructures that are being put in place?
So I think it'll threaten liquidity.
Because, you know, sorry, let me just expand on that question a little bit, because one of the things that we always like to hear is about how, you know, like refinance risk, you know, and how the pension funds don't want it, government doesn't want it. So obviously liquidity is boosted by something like refinancing. So.
Yeah, I mean, it won't necessarily help, but I think we're also getting overexcited here about the size of, and I keep going back to this, I know it's the easy answer to every question, about the size of the market here.
Yeah.
You know, nobody is going to, within PF2, have such significant amounts of their liquidity tied up in it that it's going to influence hugely the way they go on this.
I think that's an interesting transition to sort of wrap up. I think what I want to have the conversation around project costs, which is, you know, let's talk about managing construction and things like that. You know, one of the things that the project finance market for infrastructure seems to be getting smaller and smaller, but that doesn't necessarily mean the opportunity for infrastructure is getting smaller and smaller. And I think one of the perfect examples of that was the way that you know, Crossrail is being delivered, or even the London Olympics, which I think you guys were involved in. So I have a theory on managing project costs with the London Olympics. I think they just ballooned that figure up so they knew that they would have money at the end of the day to come back to the public and say, look, we didn't spend it all. But what are your thoughts on that kind of budgeting?
Well, I mean, the first thing I'd like to say is that the Olympics delivered, you know, fantastic facilities, fantastic integration of facilities, and it was a fantastic success. The challenge, which you're basically saying, is that money was thrown at it, I think, to make it happen, and you know, the assets didn't come cheap. There's no doubt about that, and I think you only have to look at statistics. For example, the relative cost of the Olympic Stadium, for example, versus the relative cost of, say, the Emirates Stadium, both built by the same contractor. There's a difference. But you know, there were a whole bunch of issues within developing a Olympics that you don't get from one-off assets.
Plus, one would argue that the Olympics venue, the siting, was actually a bit more of a challenging area to work with. Obviously.
But you know, it wasn't cheap. There's no doubt about it. But you know, it did come in on the budget and hit the timescale. But it was procured in the way it was because it had to be done, had to be delivered, and there was so much downside by not getting that right that if that meant additional investment to make sure it got over the line, then that's what was done.
Well, the timeline for procurement, that's another thing about PF2 that has been discussed, and I think now they want to get it down to, I don't have it right in front of me, 18 months. Thanks, Sakshi. Do you think that's going to happen?
Well, look, the 18 months, just for clarification, is the competitive tender phase of PF2. So effectively, from when the overdue notice is actually sent out to the point in which a preferred bid is announced, that's pretty racy. But they're saying they're going to do that because they're going to spend a lot of time and effort on the upfront scrutiny of all the documents with Treasury and the central procurement team and all the satellite teams getting everything right. All the docs are going to be standardized, and they're going to basically just do everything as efficiently as they can. I think they'll be going cap in hand to the chief secretary, as they say in the PF2, to get a few buys and a few passes for that 18-month timescale. I think maybe with the priority schools building program, you know, phase 1, phase 2, phase 3 or something, the sort of early phases, I don't think they'll hit that. I think going down the line, I think they'll be able to hit those quite sensibly. I just think that you know, it's nice to see that timescale and that constraint. I think it's helpful because I think part of managing project costs for me is not just the operational side of things, it's the procurement. And that'll attract people, but I just think it seems a little bit optimistic for what is effectively starting off with a market which exists, which has some new bells and whistles attached to it, and it's going to take time for the market to bed down.
I'm a bit more optimistic than you on that one. I mean, if we go back to the point that PF2 is primarily focused on social infrastructure, which is primarily commoditized type infrastructure, which is primarily around buildings, I don't see any reason why they shouldn't be able to deliver in 18 months. I think there's enough expertise within the market. The fact that they're going to centralise, particularly on the schools front, the procurement from a public sector perspective, I think 18 months is realistic. I think it's a smart thing to do. I think the other thing is you know, it's a flagship part of PF2 now, and the fact that they've talked about big costs being paid out if this point is missed, I think also puts an extra incentive in there. And we've all been in there thinking, blimey, why is this all taking so long? I think it will help sharpen and focus, particularly public sector due process, which we all have some scars on our backs from. But hopefully that will get the focus, I say, to drive these things through to close. But Mark makes a very valid point. I think that the stat that I saw recently was that the average on PFI was 35 months, and no matter what government did, it never managed to go down. I think where that got very much distorted was by some of the large, ugly projects like...
that we're both involved in, yeah.
Wouldn't take full responsibility, but M25,
some of the big
London Underground, and certainly some of the big defence deals. And that's just not what PF2 is for.
No, and that's a good point. I mean, schools, hospitals, what was in your guys' experience, when you were doing PFI, if you did PFI schools or hospitals, how long did they take?
Well, it depends when you do. The original ones back in, when we all started this in our short trousers back in 96 or 97 sort of time, doing some of the first hospitals, they went on for 3-4 years back some time. And some of the defence projects, started in, and without mentioning any names, started at the back end of the 90s and didn't close like 2007-8 or something like that.
I'm not going to mention one of my first ones, the Treasury building, which took a significant amount of time. So,
but they've, that won't happen again. I mean, I think the reality is that these large, complex projects will not use PF2. No. So I think it's a different discussion now, and I think PF2 is designed to deliver social infrastructure, commoditized in particular type social infrastructure, as efficiently as possible. So.
But is one thing new in this with Martin, that they said that they might, penalize, I don't know whether it's the preferred bidder or the other stakeholders if it goes above the 18-month procurement deadline?
I think it's the public sector that's going to be, the projects are going to be cancelled and they're going to have to shell out bid costs. I think that's the big
really?
Yeah, well,
that's the feet to the fire. Yeah.
Interesting.
But I think it's quite interesting because then we'll see how behaviours are formed during the tender process and how much, although it's not quite as compatible as it should be with community law, how much of this stuff is going to be pushed off to the preferred bidder stage and how much is done during the competitive stage.
So another question here from our audience. Is it your understanding that most projects will be centrally procured by IUK, so no more local authorities and NHS bodies running procurement? That doesn't sound like that's going to be the case, is it?
For the schools, the understood wisdom is that it's going to be a lot more centralised. For local authorities more generally, I suspect that might be the case too. I don't believe that's the case for any hospital deals, although I have to say the pipeline for that beyond Sandwell, I think, is pretty much blank. So.
And then moving on into funding routes for major infrastructure, I think there's another question here that will help push us into that. With respect to equity competitions on PF2, does the panel think there are long-term institutional investors who will want to participate and accept the construction risk?
Yes, I know of a few that are willing to do that. I think construction risk is just a kind of considered to be this sort of bogeyman for institutional investors. I think there are a number of institutional investors that understand construction and will take it, both from an equity and a credit perspective. It's just to be nice to have a few more of them, because then you can achieve what Treasury want, which is a true market and competition in third-party institutional equity to drive down those costs and efficiencies.
Yeah, I think there will be some. I mean, clearly, as Mark has identified, I think there's a very mixed view on this, because you speak to some experts within the pensions field in particular, which say, no way, you just misunderstand the model when you think that they're going to take this, and that they will take an investment in a project whereby they don't get return until the asset is up, built, and operating maybe 3 years down the line. Others say, actually, they will. I think we're yet to see. I think there's a lot of conversations that have happened, certainly at a high level with institutional investors. I think, going back to Mark's good expression, which is absolutely right, the devil's going to be in the detail of the conversations as they come through. And I think at the end of that, we'll see who's still standing as to who's still up for it.
Do you think there are hybrid routes that can be achieved? Because, obviously one of the things that's always been floated out there before is that some of the project finance banks, no longer can lend long-term. We'll do this sort of short-term construction financing, take and take that risk on because they've been doing it for years, and then they can somehow flip it to the institutional investors. I think just finding the right structure where that works is difficult.
Yeah, I mean, there are a number of banks that we know of actually have those products virtually in place or can do that. But we're talking about two different things there, John. That we were having a discussion on equity, now we're having a discussion on debt. And that's the funny thing about some of these discussions, they can get a bit blurred.
Especially these days.
Yeah, exactly. And yeah, especially with the sort of deleveraging. From a debt perspective, I think institutional investors, banks can play a good collaborative role together in terms of using credit skills of the banks and then flipping these things over. The problem I find is that finding institutional investors that are willing to commit and price for 2-3 years for that flip to happen, most of them can't. So, you know, there's some quite interesting debates and discussions to be had, and I'm sure when we get onto it, we talk about the UK guarantee scheme, which may be something that can assist in those bridging the gap discussions. I think a lot of people get fixated on financing. I think we'll talk about pipeline a bit later, but it's all about funding at the moment. The fact of the matter is we don't appear to have a lot of it in the UK. It's either, with a very simple man, we're either going to be funding infrastructure through general taxation and paying the entry charges or whatever it might be, or user pays. And government appear to be falling on the line that they really want to move as much away from the taxpayer to the user. So tying all that together and the discussions and the utterances to the public about the emphasis of PF2. PF2 doesn't seem to have, it gets a lot of debate and a lot of discussion. I don't think it has quite the importance.
It's going to really limit who can afford to go to Birmingham on a high-speed train if they expect the user to pay.
It's going to be a combination, it has to be, because a lot of the benefits of infrastructure, particularly something like HS2, is not just the user. There's all sorts of economic regeneration. There's all sorts of other positive economic impacts, and I'm not putting my hat down saying I support or otherwise in it, but there are often significant benefits of the development of infrastructure that just don't get recorded, and there is no way that the fare box will cover the cost of HS2 by any stretch of the imagination. And I think, you know, even with what we've seen with the A14, you know, in respect of how that has been looked at by DFT, again, the ability that for the motorist to fund through a tolling type mechanism, the A14 extension, that additional lanes, that doesn't work either. So what I think is important, and I have to say I think we're getting positive noises from the Treasury as to how they evaluate infrastructure investment going forward, is that it's not just on the defined outcome in terms of, so for a road, the benefit to the motorist. There are broader economic benefits. There's economic benefits around the construction period. We've recently done about to announce next week a significant piece of analysis around the economic value of large infrastructure investment. And it shows that the value to the economy is really very significant, but not taken into account in the way the Treasury and the Green Book evaluate the value of infrastructure investment. And you know, I think there's a long way to go here till government properly analyses the value of infrastructure going forward. And I think that's critical to the debate.
Well, it's critical to high speed too. I mean, you know, one of the sort of conversations, you know, kind of in the side wings of our little breakfast the other day was how much. I mean, it's really hard to get your head around how much really is being budgeted for that particular project, you know, and you know how long the country is going to be paying for it. And you know, the same discussion around airports in the Southwest here, you know, building a new hub airport, you know, I mean, it does, you know, start to question, you know, why, you know, how are we going to invest billions in putting a new estuary airport out there, and then the high-speed rail links into London and stuff like that, and will that recoup itself on top of, you know, Crossrail 1? And the other day with HS2, you know, I think the Tube boss came out and said, you know, if you're going to do HS2, you're going to have to do Crossrail 2, because otherwise Euston's not going to be able to handle the traffic. So,
well, it's part of an integrated solution. I have to say, I think, again, another failing of both, well, of successive governments is the inability to be able to hang an infrastructure plan on the back of a broader economic plan. And I think if the country had a broader economic plan, then it would be making the case for investment in infrastructure so much easier, because you could see it as part of a broader picture, because infrastructure is not an end in itself. And I think one of the challenges that we have had in this industry over, certainly in more recent years when funding has been so much tighter, government funding that is, then the ability to make the case for infrastructure is so much more difficult when you haven't got it as part of a broader economic plan. And no recent government has been able to really articulate that.
And we can see that, you know, David Cameron, Prime Minister, came away from Brussels with a clutching bit of paper, being quite excited about getting a concessions on a EU budget, but actually the Connecting Europe facility cuts are going to probably have more impact on infrastructure in the UK than some of the capital spending cuts we've had there. I think Nick's made some fantastic points. I think it's great that Deloitte are spending their time and efforts putting in place some research on this, because I think it's really valuable. One thing that really interests me, and it's not meant to be part of a political discussion, I'm trying to make this as apolitical as I can, but I'm genuinely very interested in what Lord Adonis and John Arnott are doing around looking at, because that's what opposition parties do. When they're in opposition, they don't empower anymore, they think. So I think it's really interesting that Arnott and Adonis are spending a bit of time looking at the links between infrastructure, some kind of infrastructure commissioning body, and the link with that in politics, and how it can be decoupled. Because the coupling up of infrastructure and politics, I think, has caused some major issues in this country, and it's difficult. Yeah, so these infrastructure projects are 20, 30, 40 years in their gestation, and we have political cycles of 5 years. So I'm really going to be quite interested to see what comes out of that discussion.
I think you alluded there to the Connecting Europe facility in the EIB. So this next question mentions that. So PF2 does not fully solve the issue around limited construction risk appetite from institutional investors. Does the panel believe that credit enhancement mechanisms such as ING's Pebble, Hadrian's Wall, and more recently the EIB project bond, which is funded by that facility, will this help protect? Will this help projects to reach investment grade and therefore attract more investors? Credit enhancement, do you guys think it's going to work?
Well, listening to a couple of rating agencies just indicatively in public forums, they seem to say that with the right levels, it can happen. The credit enhancement can reach the right credit enhancement, and so the right ratings necessary.
I was in chatting with a particular ratings agency the other day, and I kind of I alluded to the fact that if I'm a pension fund or if I'm a fund manager and I say I need single A credit on or that's what I need, it's almost like a traffic forecaster going out and somebody having having their business case saying it needs this forecast to get it, and then lo and behold the traffic forecaster comes back and gives it, and that hasn't necessarily always worked out the greatest for some people. I mean, do you think there's a risk of some of that happening, or am I just too pessimistic?
I think there is a risk of it happening. I think credit enhancement can and could well play the role in getting things over the line, but I have to say, it all costs. And at the end of this, when you add up a creditly enhanced, tightly structured project that meets the credit rating requirement of an institutional investor that will then put its scarce funds into a major infrastructure project, what is the cost? How do we then continue to demonstrate that that is value for money? And I have to say that's a little bit of an elephant in the corner of the room here. That in the same way for many years people said PFI and private finance wasn't good value for money to the taxpayer. I think we mustn't forget that as we look for these more structured type solutions to bring in institutional investors.
And financial markets are consistently changing. I mean, this is, we spend a lot of time working on a new model now, and the financial dynamics in 5 years' time might be completely different.
We've got to keep people in a job somehow.
We've got only about 15 minutes left, so I want to move on to the UK government guarantee scheme, because I think in the conversation that we had last week in the roundtable, this was one of the more interesting discussions. And Nick, you kind of raised the point, so maybe you could kick it off. What is the UK government guarantee scheme? Because there's, to some extent, some haziness around it that people don't completely understand.
Well, I think, and again, the definition of it is I mean, I think it's fairly clear. It's government stepping in to make guarantees to enable financing of projects to get over the line where otherwise they are struggling to do so, but for good and nationally significant projects. What the government guarantee is not, it is not a vanilla solution that is to be applied to each and every project. It is going to be bespoke, and already there are good examples out there of how it is being applied. So the more, having just said that, the more traditional vanilla type government guarantee that we'll see most of, I think, is very much similar to what a monoline wrap was, in terms of just guaranteeing and putting the AAA rating of the country behind a bank debt type solution, giving effectively insurance to the funders to the project. But I think the government will be prepared to guarantee other risks, other particular risks, other type demand risks perhaps, other potential planning type risks potentially, throughput risks on projects to help get things over the line. So I think that's broadly what it is. But my follow-up point to it is that once again we've been what, 3/4 of an hour into our session here, which is what, 3/4 of the time, and we've spent most of that talking about, well, almost all of that talking about PF2, and we've got final 10 minutes on the guarantee. I think the guarantee is going to be far more important in driving infrastructure, driving investment in infrastructure over the next 2 to 5 years than PF2 ever will be. And you know, that's where we as an industry now need to be really taking this forward, seeing how it can be applied in the 2 years that it's available. My own hunch is that it'll last longer than that, but I think it could be really significant, and it will affect the biggest economic infrastructure type projects, particularly energy and particularly transport. So I think it's critically important. I think it's for us as an industry to help IUK make this work, get it out there, and I think we will start to see, you know, some real project flow that we might not, that we wouldn't have seen before, and to make this work.
And here's a comment of its time. I agree with Nick.
There's another question here, which I think Nick may have already just kind of answered in a roundabout way, but I think it actually he makes a point before he asks the question. It's a public sector guarantee of construction risk and/or senior debt combined with public sector equity, stake, may materially impact whether projects are budgeted for as revenue or capital. Has HMT considered this issue? So revenue or capital in terms of, you know, the guarantee of construction risk?
It does. If government guarantees and this is, I am an accountant, but I'm not. It's not my chosen subject, as it were. But balance sheet treatment is important. It affects the national balance sheets, etc., and it creates constraints. And if as I understand it, if more than 50% of the capital value is guaranteed in whatever way, and again, the specifics of that are probably well beyond me, then it has balance sheet implications, which, you know, could potentially have issues. But the message that we are receiving from IUK on the projects that we've certainly been talking to them about is that balance sheet is not a red light for government guarantees, and if more than half of the capital value has to be guaranteed in a way that does take a project on the balance sheet, that's not necessarily a red light, but it's obviously common sense tells you it's probably better if it doesn't do that.
No, just say I think public sector net debt is a big sensitive issue for Treasury. But as Nick said, we've not come across situations where they've put up a red light and said no, you can't do that anymore. I think with the government guarantee scheme, the thing that, you know, sort of unpeeling the onion on this, I think what's becoming more and more interesting about it is it can potentially apply to more and more things. So if I go back to my point before about, you know, movement away from taxpayer funded to user paid, you look at UK government at the moment, actually it's probably not the biggest procurer in the infrastructure market. It probably is not. You know, the utility companies, the water companies, National Grid, the new build nukes are not going to be built by government. They're going to be built by and commissioned by generators. So, you know, you think about infrastructure. You know, back to the point about PF2 not being as significant as it once was, and going forward, that I agree with Nick. Again, the UK guarantee scheme is going to be, you know, it's going to be quite a big pump primer for some of these economic infrastructure projects.
And that came across to me as a message in the discussions we were having the other day, which a lot of people didn't. You know, I think a lot of people were kind of, I don't want to say dismissive of the UK guarantee scheme, but it almost kind of felt like the Treasury Finance Unit, you know, in the sense that it was, you know, a quick fix for maybe 1 or 2 projects or whatever. I mean, what the guarantee scheme's been used on 1 project?
It's only it's only debuted with the Crossrail, and I was going to ask the panel, good, bad, positive for Crossrail.
For the guarantee. So I thought you were going back to the Treasury Infrastructure Finance Unit for a moment.
No, I did. I mean, so the original question was, is this, you know, I think a lot of people had a sense that the UK government, it is different.
Yeah.
I mean, that it would be kind of a similar sort of thing. But that's the message that's coming out is it's a much bigger deal than I think a lot of people.
I mean, TIFU, the Treasury Infrastructure Finance Unit, was about providing debt. It was like being a lender. This is about providing guarantees to projects. Those guarantees can be structured in all sorts of different ways, which is sensible, commercial for the project, and gets them over the line where otherwise they wouldn't have done so.
It's very flexible. That's one of the things I think.
In short, it's a guarantee. It's not a provision of funding.
So that's what I was wanting to get at. So with them, you know, making a debut with Crossrail, do you feel, yeah, good, great, Crossrail needed it, or is it just more like?
I mean, does Crossrail absolutely need it? I mean, we'll probably able to answer that time when it gets near to financial close. I don't know whether, and I'm not working on that project.
No, nor mine, no.
So I can't give the answer to that. I wouldn't have.
It's nearly built.
No, we're talking about this, the rolling.
Oh, the rolling stock. Sorry.
Because the transaction that has apparently got government guarantee green light is the Northern Line extension.
Oh right, yeah.
Battersea.
Oh, that's right. Yes, there's a Battersea. Yeah.
Effectively underpinning revenue for the GLA. I mean, that's another demonstration of an interesting and innovative way the government are using their balance sheet in a way that will, you know, benefit.
Actually, the beneficiary in that was not actually private sector, but it was public sector in the Greater London Authority. Going back to credit enhancement, because we have a question here about it. What kind of credit enhancement does the panel think would be needed to get a typical PF2 project to a single A rating?
Well, there isn't a typical lawyer answering a question. There isn't a typical PF2 project yet because we haven't seen one. But
I don't think there is needed. I don't think I do. I mean, the structuring of PF2 is also reducing the is enhancing the equity proportion within a deal, so the gearing is reduced. The key aim of that is to get to the credit rating that is believed to be required, the magic A. If that requires credit enhancement in addition to that, then I think they've got it wrong. So hopefully the answer is it's not needed.
Okay. Final topic on our bullet points for today was and you alluded to it earlier, is there a legitimate project pipeline? You know, one of the things I think the credit enhancement products have run into is actually there's not a huge demand of available projects out there for their services. So they're all bumping into each other, trying to get the very few that are out there. So what can we do about the project pipeline? Is there? I mean, you know, I guess in a way I kind of deconstruct this and say like, so the public sector obviously is the biggest initiator of most projects, and the European sovereign debt crisis has really kind of, you know, squeezed down on that. And do we see any kind of lightening up on that where we actually have any kind of optimistic view that some more projects will start to flow into the marketplace?
Well, I have to say I'm not the biggest optimist on this, but I'm happy to go first if it helps. If one looks at the deficit reduction plan that this government set out on taking office back in 2010, and you look at where it is today in delivering the public sector reductions in spend, you also then combine that with actually, in order to get to the overall deficit position it aspired to because of a significant reduction in tax income, then that implies further public sector spending reductions. Then the easy conclusion to come to from that is the funding available, government funding available for investment in anything is getting worse rather than better. So is there going to be more funding available for infrastructure? Unless this government decides that infrastructure is going to become a higher priority because it really does generate economic growth, which some might argue is more of a plan B than a plan A type approach, then I have to say I think the prospects for an improving pipeline are not good. I think, flat at best would be one's conclusion. However, if one looks beyond the traditional PF2 type infrastructure market and you look at what, as Mark identified, the utilities, the nuclear players, etc., then that's a different matter. And with the guarantee scheme available to them and creative approach to that, then there could be significant investment, needs to be, quite frankly, significant investment, particularly on the energy side. But when it comes to the more traditional social infrastructure, I have to say I think it's pretty bleak.
You've stolen my thunder because I was about to say the same thing. I think the PF2, apart from the schools program and a few legacy equipment type projects, which aren't probably PF2 anyway, they're more PF5, whether it's Crossrail rolling stock, finally get Mersey Gateway away, Thames Link will finally close, those sorts of things. Doesn't seem to be a huge pipeline, but if you were to redirect your skill set towards the utilities, whether it be water, power, distribution, there's a huge pipeline, and the EMR is finally settling down. The nuclear new build program is going to have to get started. Gas-fired power stations. There's a huge amount of projects in the pipeline, which can potentially benefit from the UK guarantee scheme, but they are not PF2. PF2 is
very limited in
very limited. Yeah. It's effectively bricks and mortar, and even those bricks and mortar schemes, I'm not sure whether PF2 is suited for some of the complex housing projects or some of the potentially complex and I think exciting regeneration projects, which are probably more likely to benefit from some kind of TIF model with some kind of UK government guarantee scheme backed into that as well. So I'm seeing the relevance of PF2 sort of dissipating and core economic infrastructure becoming much more interesting, especially from what's on my desk anyway.
It's really not PFI. I mean, it really is the shadow of, or a fragment of what PFI used to be, isn't it?
Yeah.
If even that.
Yeah. I think if you look at what hopefully will be the infrastructure elephant, PF2 will be the wart on the backside of this.
I'm sure there are some people who will happily agree with you on that. I think we're pretty much out of time, and since we have no more questions that have been handed to me, so I'd like to thank Sakshi, first of all, most importantly, for all the hard work that has gone into obviously the breakfast briefing that we did, and this webinar. Most of us have just shown up for it. Sakshi has been beavering away on it in the background for a number of weeks. So thanks very much, Sakshi. And then, of course, I'd like to thank our guests, Mark and Nick. As always, delighted to have you guys come over here and have I was going to say tea, not quite at the BBC, but we're getting lovely new facilities. It's getting a little better around here. So.
Well, that's the beauty of investing in infrastructure, John. Thank you very much again.
Yeah, cheers. Thanks, everyone.